which we are all a hostage to, as I said. And of course, interest rate movements generate capital city house prices. Interest rates generate price growth, but local factors determine the rate of growth. Okay, so interest rate settings, which are generally national, determine the direction of house prices, but local factors determine the speed of our house prices. So that's very important for us, isn't it? When we're talking about property, what interest rates are going to do. So let's have a look at, whoops. So that is our mortgage rate cycle. And we can see how it's got that lovely little roller coaster graphic to it. 9.5. That was your mortgage rate in 2008. And of course, it's terrible. How did you pay 9.5? That's shocking. Terrible. It must have been a depression. No, it was a boom. Higher interest rates are good news, believe it or not. Low interest rates are not good news. I mean, they're good news, but they're not economically good news, right? So we can see that wave of interest rate activity, and of course we've had that record period with interest rates on hold. And these are mortgage rates, not official rates. And we're down now to the lowest levels we've ever had in terms of mortgage rates. So let's have a look what house prices do as those mortgage rates change. And you can see that there's a relationship between higher interest rates and lower prices, lower interest rates and higher prices. Now, you can see the underlying energy in the markets, but of course, markets are operating at different levels according to different factors. Now, Perth boom. One stage, the Perth housing market matched the Sydney median house price, 2007 through the boom. And at one stage, the Canberra median house price in 2011 was on track to match the Sydney house price too. Can you believe it? But local factors then started to generate local outcomes. And you can see now that those, and the bump in the ride there is because of those APRA-initiated higher interest rates, that the Sydney market's now coming back to the pack. It's not a crash. It's not, anything that's going to cause a significant drop in prices, because it's been driven by an easing in the capacity of people to pay more for housing with interest rates apply. I mean, there's no magic to paying more for a house. You can only pay more for a house if you go to the bank and say, look, I'm going to find another 50 grand to buy this product. Right? That's okay, that's fine. Well, I can't give you a cut in interest rates. So you're going to have to find it by an increase in income. Well, I haven't got an increase in incomes because incomes aren't increasing in Australia. So you can't pay more unless the bank gives you an interest rate cut, or unless you're earning more money. Even if you've got people lined up around the block for housing, if you don't have lower interest rates or higher incomes to drive the capacity, you won't have higher prices. You understand that? It just doesn't create itself out of a magic house price box. And that's why we're starting to see the strong markets easing, even though underlying demand and supply is clearly ahead, or the underlying demand is clearly ahead of supply in all those markets, which we'll get. So, and that's the Canberra, sorry. And Canberra's actually gone from growth rates underneath the other capitals, and is now pushing growth rates above the smaller capitals.